So let's go to skill number 7. Invest money wisely. My favorite subject, because I'm an investment professional. Invest your money wisely. I put in a few items in here. The list can be much longer, but for today, we're going to talk about fees, risk tolerance, diversification of your portfolio, and considering taxation on your profit. So we'll start with the fees. Okay, for those of you who are in United States or in Europe, because I know there's people that will probably hear me down the road, anybody who is familiar with investment products, there are many different investment products that you can purchase. You can have an investment account in one of the capital markets. You can purchase mutual funds, stocks, bonds, exchange traded funds, ETFs, and so on and so forth. Those are types of investments where you actually buy shares of publicly traded companies, for example, when you're buying stocks. Those investments actually go up and down. So you can buy I don't know, a stock for Home Depot, for example, or you can buy stock, what's a popular stock? Facebook stock. You can actually own shares of Facebook. You can be an owner in a company of Facebook, right? And if Facebook does well, your money will go up. And if Facebook does poorly, your money will go down. So say I bought 100 shares of Facebook, and Facebook is doing really well. They report good earnings. They're doing really great. They have new products. Then, the price of the Facebook will go up, and of course my investment will go up, and vice versa. So let's think about fees. There are a lot of fees associated with investment products. Some are very obvious fees, and some are very not obvious, hidden fees. For example, when you look at mutual funds, most people don't realize when you buy mutual funds, there are internal fees in the mutual fund. They're called expense charges. And those fees are there for a reason. Obviously, there's a reason for fees because you have professional money managers. In fact, you have a team of professional money managers where they've gone to very big schools, and they have a lot of letters behind their names. They have a lot of licenses and so on. And their job is to do a lot of research and pick investments for their mutual fund that they're managing. And how does that work? A lot of individual people, they will pool their monies together, and a mutual fund usually has a mandate that they have rules that they have to go by. For example, if this mutual fund is a growth-oriented fund, or it's a mutual fund that's going to only invest in stocks in China, or it's only going to invest in growth stocks or value stocks, they have their rules that they need to abide by. But then people, if they agree with the mutual fund, if it's a aggressive fund or moderate fund or conservative fund, if you like what they are doing, you can pool your money, you can put your money in that mutual fund, you can buy shares of the mutual fund, and those money managers, the team of money managers, will make decisions on your behalf. They will decide what to buy, when to sell, how much to buy, and so on. So it's an actively managed fund. For that, they charge fees, and they're called expenses. There are other fees associated with investments. There are things like commissions. There's things like internal fees, like I said. There are also taxes that have to be held, and so on and so forth. So I don't want to spend too much time. I just want you to know that there are fees, and the fees will make a difference. If you are buying a mutual fund that has high fees, and if they make 10% return, they're only going, let's just say they're charging 1% in fee, even though in reality they make 10%, they're going to take their 1% and they're going to report on their annual report. They're only going to report 9%. So for an average person, they're saying, oh, I put my money and I earned 9%, but they don't realize that there is a 1% fee they're paying. And this is not that important when the stock market is going up and everybody's making money. But it becomes far more important when the stock market is going down. So you put money, and instead of going up, the market went down, and now the mutual fund lost 10%. So the reality is they lost 11%, they took 1%, and the other way around. They lost 10%, they took their 1%, and now they're showing loss of 11%. So fees are very important. Exchange traded funds are much cheaper. The average fees on exchange traded funds can be anywhere between 0.1% to 0.75% average trade fee, and then average fee on mutual funds can be anywhere between 0.5% to as much as 2%. So they're very, very important. There are other products as well. For example, annuities have high fees. They can range as high as 3.5% and so on and so forth. Again, in the interest of the time, I don't want to talk too much about it, but any questions that you have, any concept that we're discussing today that you want to learn more about on your evaluation form, please, there is a spot for it. I need your feedback. I need to know what part of the presentation is more important to you, what part of the presentation you want to hear and learn more about. So next time in the future, we can concentrate on that. Let's talk about risk tolerance. Very, very important. I call it the stomach for losing money. And I've had many experiences with this. And it's a personal choice and a personal, I guess it's a personality thing. It has a lot to do with your personality, but also your education and state of mind. If I have $1,000 and if I put my money in an investment option, into an investment product, and if the stock market crushes and my $1,000 becomes, it's worth only $700, how would you feel about that? Some people panic. Some people can't sleep at night. Some people just can't handle losing money. For those people, you probably don't belong in the stock market and you probably shouldn't be doing those types of investments. But for other people, they like it when the stock market goes down and they say, oh, this is an opportunity for me to buy this really good company at a cheaper price. And they actually put more money into the investment. But it also has a lot to do with your time horizon. As a financial planner, when I'm talking to people, when I'm talking to clients, the first thing we'll ask is, we'll talk about time horizon. What is your time? If you have this chunk of money, what is the purpose for this money? What is the goal with this money? Do you want to save money to buy a house? Do you want to save money to start a business? Do you want to save money to send your child to college? What is the purpose of this money and what's the time horizon? Do you need your money back from your investment in 1 year, 3 years, 5 years, 10 years, 3 months? It's really crucial to understand when you need your money, because if you need your money in 6 months, then you should not be buying stocks or mutual funds. If you don't need your money for 3 to 5 years, then again, there are appropriate investments based on your risk tolerance and based on your time horizon. So any good financial planner, any good financial consultant has to ask you these questions. They have to understand whatever it is that you're trying to accomplish, what are your goals, what's your time horizon associated with this money, and what is your risk tolerance, what is your appetite for losing money. Because everything is great when things are doing well and markets going up and your investments are doing well. We can all be happy with that. Let's concentrate on the worst case scenario. How would you feel if you put in X dollars and now your investment is down 20% or 30% or even sometimes 40%? So those are very, very important. Risk tolerance is very important. Going to the next point that I want to talk about is diversifying your investments. Very, very important. In the US, we call it, don't put all your eggs in one basket. It's just an idiom that we use in the US. Don't put your eggs in one basket. For those of you who participate in our conversation clubs, we talk a lot about idioms because you cannot, translate these words verbatim or, because, it's the idea behind it is that you need to diversify your investments. How do you diversify your investments? If you're doing this investments in the capital markets or in the stock market, you don't want to put all of your money in one stock. You don't want to put all of your money in the same sector. You want to diversify. Let's just say you will diversify and you'll put some investment into technology sector. You'll put some investments into the healthcare sector. You'll put some investments into bonds. You'll put some investments into equities. You'll put some investments into currencies. So you want to have different things happening because different investments and different sectors go up and down at a different rate and at different times. So typically speaking, when, as financial planners, we will look at things like alpha and a beta of a portfolio or alpha and a beta of the investment. So you want to have investment that have opposite correlation to each other. For example, stocks and bonds usually act in an opposite correlation. Usually when stocks are up, bonds are down. And vice versa. If bonds are up, stocks are down. There are reasons for that. I'm not going to get into it today. We'll talk more about that if you guys want to learn more about investments. I just want you to understand that there are ways to diversify your portfolio. And you can do that not only just with stocks, but also with any other investment, whether it's investing in real estate, for example. You don't want to buy all your real estate investments in the same market. You know, you want to diversify, whether it's real estate investment, stock investment, or any other investment. Last point on this, and we'll move on, is considering the taxation on your profits. Very, very important concept. In the United States, we have two types of investment portfolios. We have taxable portfolios and non-taxable portfolios. I'm not familiar about Armenia. Maybe we should look into that, Christina, so we can understand. But in the United States, you could set up a non-taxable portfolio, which comes in the form of a retirement plan. We have things such as IRAs, SEP IRAs, 401k plans, and Roth IRAs. Some retirement plans are tax deferred, meaning you're just deferring the tax. You're not paying the tax now, but eventually you'll pay that. And some portfolios are completely tax-free, like Roth IRAs. They're completely tax-free. It's a special account you put in. In my opinion, that's a gift from the IRS. That's a gift from United States government that every U.S. citizen is entitled to. Not every, actually. There are income caps that you have to be under. Again, I'm not going to get into this today. We'll discuss this again in more detail next time. But you have a taxable environment and non-taxable environment. Why is this important? If I have an account that's a taxable account, that's a taxable investment account, if I made 10% and I'm in, 30% tax bracket, if I made $1,000 or I made $100, right? I'm only going to keep the 70 because the $30 goes into taxes. In a non-taxable account, if I made $10, I keep the $10. If I make 100, I keep the 100. I pay zero tax in a non-taxable account. So your money is earning money, your interest is earning interest, and it's compounding much, much, much faster. And if you fast forward 10 years, you could actually double your investment in a non-taxable account. Just doing the same thing, just using the same investment. But just the fact that you're either paying tax every year or not paying tax every year is going to make a huge difference. So be conscious of that. And when you're doing investments in a taxable account, make sure you understand the taxation, because there are some mutual funds that are more tax heavy and other mutual funds are less tax heavy. There are certain funds that give you higher dividends. The dividends are taxed at a different rate. And there are other mutual funds that are they're invested for growth or versus they're invested for value. Just understand the difference on different investments when it comes to taxation. Okay, any questions about this? I know I put in a lot. I gave you a lot to digest. Any questions, any comments, anything at all? I know I have 3 things in here. Let's just take a look and see what we got in here. Any questions, ladies and gentlemen? Please raise your hand. Let me know. And we actually are coming up to exactly 1 hour, and I have 2 more skills that I want to go over.